The webinar presentation is about to start. Please turn up your speakers now.
Hello there. Hi guys, this is Hector Deville. Welcome to this quick little webinar session that I've put together. I hope we all have a good time today. I'm gonna try to make it as entertaining as possible, but at the same time very lecturing, all right? Or that's basically what I have in mind. Let's see how it goes. Anyway, today we are gonna review the fake breakout strategy, which is a little advanced, perhaps. Okay, whenever you are actually dealing with any fake breakout strategy, the fake factor makes it a little more difficult to trade, or at least a little more, well, confusing. But at any rate, I'm gonna try to clear up any doubt or any question you may have, today at this webinar. All right, let's see how it goes. Now, before we get started, I'm going to ask you for a few favors, guys. I'm going to ask you to give me your attention. That means try to switch off your mobile phone, try to cut down on the Skype chats or on the email, all right? Just because, I think this is going to be a very worthy session. I think you're going to learn something fantastically cool, a very profitable trading strategy, trust me. So I'm going to ask you just to have your attention as much as possible, all right? And moreover, if for whatever reason you have any question, any doubt, or, well, you may want to simply share any comments with the rest of us, somewhere in this page, probably under this video, you should find the chat box. You can type in your questions, and at the end of the webinar, I'm going to try to address them all. If for whatever reason, just because of sheer volume, I can't address them all, then worries not, because all those questions are actually sent to my email address, and I'll make sure to answer them all after the webinar. All right. So, let me give you a quick rundown on the points, the topics we are going to cover today. First of all, I'm going to run a quick introduction on the Forex on the fake breakout Forex strategy, just to make sure that we are all on the same page, all right? Then I'm going to go about explaining the core principles of this strategy, just the typical PowerPoint slide presentation showing you the theoretical concepts, the logic behind this strategy, again, just so you understand what type of a strategy we are trading here. Moreover, we are gonna move on to actually reviewing some live examples, okay, some live Forex charts, just so you see how these theoretical concepts actually apply on real Forex charts, okay? Finally, I'm gonna wrap everything up, and we are gonna take some final notes that you may want to keep for for your reference. And finally, we are going to go about a quick questions and answer session where I'll just address the questions that I've received so far through the webinar. All right, that's basically the structure of today's session. More or less, it's going to be about a 1 hour session. That's my target. All right, maybe a little shorter, maybe a little longer, but around 1 hour. Okay. Anyway, let's cut the chit chat and let's get going. Well then, the fake breakout strategy is based around price reactions around key levels of support and resistance. Okay, we are going to analyze how price reacts to those key levels of support and resistance. Now, needless to say, in order to have a breakout, okay, a breakout setup in your chart, first of all, you obviously need a clear reference level of support and resistance to break out from, okay? Regardless of whether it's a valid breakout or indeed a fake breakout setup, firstly, you require to see a reference level of support and resistance to base the breakout from, okay? Now, those levels of support and resistance can be of two types: horizontal levels of support and resistance, or diagonal levels of support and resistance, which is basically a trend line, regardless of whether it's a downward trend line or an upward trend line. It works either way, okay? Regardless of whether the horizontal level is a resistance level or a support level, okay? Again, like I say, it works either way. However, However, like any other type of breakout strategy, the pattern becomes much more reliable, much more accurate if it's based around a top level of support and resistance instead of a, let's call it a secondary level type of support and resistance. Okay, so you want to make sure that you trade those fake breakouts that are based around top swing highs or swing lows instead of these second class swing highs or swing lows. Okay, these ones give out the very best, the most profitable trading opportunities and the most reliable patterns rather than this type of swing highs and swing lows. Okay, pretty much the same thing goes for trend lines. You want to see fake breakouts or valid breakouts around the absolute trend line, meaning the outer trend line within a trend. Okay, you know that whenever you have a trend, you can usually draw outer and inner trend lines. For example, this is an outer trend line because there is no further trend line I can possibly draw beyond breakout levels. Okay, if price breaks free or breaks through from that trend line, then there is no other trend line I can possibly draw here. Okay, let's imagine that instead, let me actually modify this, just give me a second, guys. Let's imagine we had this type of string structure, and from here we can actually draw an inner trend line, isn't it? Linking this swing high there with this inner swing within that trend. So there's our inner trend line. So if we get a breakout from that inner trend line, and from there, let's imagine that we do indeed get a fake breakout. Well, this pattern is not going to be as reliable as if we got the breakout, the fake breakout setup from this other trend line, just because this is indeed an inner trend line, and that's just not as important as the outer trend line as a whole. Okay, so remember, you want to have a clear and obvious, okay, a top class level of support and resistance and not a medium class level of support and resistance. Okay, if you spot a fake breakout setup around this type of levels, then just be aware that that's not going to be a high quality signal, and perhaps you may want to pass altogether on that setup and wait to see the type of price reaction you get whenever price comes back to retest this specific level or that specific level. All right, that's my recommendation. Anyway, let's do imagine that price actually comes to retest all the way up there the absolute level of support and resistance. So let me just simply copy and paste this line there. All right, and like I say, price does actually come all the way up there to retest that absolute level of support and resistance. Well, once price is up there, there are three possible outcomes to this scenario. Outcome number one, we get a bounce off that level. Therefore, this absolute level does confirm as a resistance level, printing out what's known in the trading lingo as a double top. All right? I'm sure you guys know what a double top is. Okay, so that's basically the confirmation of a support or, in this case, resistance level. Outcome number two, we get a valid breakout on price that's pushed through in momentum. Okay, breaks through this level of resistance. And well, it continues pushing on its merry way. If that's the case, we cannot trade a fake breakout setup. We would have to indeed, look for continuation moves. Okay, continuation moves in the direction, obviously, of the breakout. So we would have to look into a whole different type of trading pattern, and therefore a whole different type of trading strategy. On the other hand, outcome number three, let's imagine that price does breach through, okay, but immediately after it turns around and it comes back below that resistance level. That's our fake breakout, and that's the specific outcome we are going to analyze today. Okay, I'm going to show you guys how to actually trade this type of outcomes. All right. This is more or less the type of price pattern we would see in our charts, and as you can see, it's a reversal move, okay, a reversal swing, and that's the main difference between valid and fake breakouts. Valid breakouts are continuation swings, whereas fake breakouts, as you can see, are reversal swings. Okay, their nature is completely different, and therefore the way we trade, the way we approach is each type of breakout has also got to be completely different as well. Anyway, from now on, I'm going to stop talking about valid breakouts because today's session is all about fake breakouts, and that's the only case scenario I am going to contemplate from now on. And by the way, it's exactly the same thing as far as trendline goes. Okay, we are also going to be trading reversal breakouts, reversal reactions around trend lines. Okay, it works exactly the same, but just for the purpose of this presentation, to keep things simple, I'm going to, basically explain the whole thing around horizontal levels of support and resistance. But again, like I say, whatever I explain in this case scenario applies equally to this other cases scenario. Okay. By the way, before I go about explaining the specifics of the fake breakout strategy, what it looks like, where to enter the trade, where to place your stop loss, your profit taking levels, etc., etc., I would like to tackle just for a minute or two on the market psychology behind this price pattern. Okay, basically I want to review why do fake breakouts occur and why do they occur so often. And in order to answer these two questions, I need to explain you guys how the market psychology, basically the market mechanisms work, just so you understand the logic behind this pattern. Okay, this is going to be a little bit of theory, guys, a little bit of theoretical mambo jumbo, but please stick around. This is just going to take a minute or two, and it's going to give you a much deeper understanding on this strategy as a whole, and moreover on how to trade it profitably. So I'm sure you've heard the expression fear and greed is what moves the market, right? Any speculation market really, forex, stocks, oil, gold, futures, bonds, it doesn't matter. What fuels, what moves, what spurs the market is the combination of fear and greed among the investors, right? The participants of that market. Well, that's fundamentally true, by the way, all right? And that's the reason, the mechanism behind the fake breakout strategy. Let me try to explain what I mean. Whenever we have a trending situation in the market, regardless of whether it's an uptrend, such as this one, or a downtrend, it doesn't matter, the market's predominant sentiment is greed. Okay, greed is what fuels a trend. How is that? Because as long as the trend keeps on pushing, as long as the trend remains in place, the investors' greed to make more and more and more money is what spurs them into continue placing orders and positions within that trend, because they believe that the trend is going to keep on pushing, and therefore they are looking to make more and more money, okay, out of that trend. So trending situation equals greed as the predominant market sentiment. However, in the other hand, counter-trend moves are fueled by fear. Fear from all those people who've been making money all along the trend, and, well, they basically fear losing all those profits back to the market. Okay, imagine you took a trade right there, and you saw that price began to move against your best interest, right? Against the established trend. Well, it's not really difficult to imagine how that previous excited and greed-fueled state of mind can easily give way and turn into fear. All right, so all in all, trending situations equals greed, counter-trend situations equal fear. Okay, that's common sense, right? We can all understand that. However, and here's where it gets tricky. Here is where it gets all psychological, and I love it. Let me see if I can find the right words to get my point across. Fear is a more volatile, it's a more primal feeling than greed, okay? It grabs our attention much quicker than greed. Basically, what I am trying to say is that people are more afraid of losing whatever money they got. They are more afraid of losing their trading account than they are keen on continue expanding their trading account. Okay, you react much more quickly whenever you see that you can lose something valuable than whenever you may find an opportunity to continue growing on whatever you already have, right? So As a result, trends and greed built into the market at a much slower or milder fashion than counter trend moves or fear. Okay, I'm sure if you could draw in your chart the angle on any average trend line, you would see that this angle here is actually much milder than the angles that you get from counter trend moves. That's because, like I said before, fear, from a market psychology point of view, is a much more volatile feeling than greed. Okay? I'm not saying it's more powerful, but certainly people react much quicker to it than to greed. Anyway, why am I telling you all this nonsense, all this fear, greed, market psychology mambo jumbo? Well, because that's precisely the reason as of why the fake breakout strategy actually comes in place, okay? Because as you are gonna soon see, this entire strategy is based around the battle between fear and greed as the breakout takes place. If the greed comes on top, if the greed remains as the main market sentiment, the breakout is going to become a valid breakout. But in the other hand, if fear becomes the predominant market sentiment, we are going to go through a fake breakout situation. All right, that's why I wanted to run through that little quick introduction. I hope you don't mind. At any rate, we are through with that. So, like I was saying before, this entire price pattern is based on how this greed that comes in the market as the breakout begins to take place very promptly turns into fear as price reverses. Okay, so we are gonna make our money on this sharp reversal move. We are not going to trade the initial breakout. That's not the point of this strategy. We are exclusively going to make our profits on the sharp reversal move. And please mind that I said sharp. Okay, this is an acceleration move in the opposite direction. This is a momentum filled move. All right, and the reason as of why it's momentum filled, the reason as of why the reversal takes place so quickly, is because, like I said before, traders react faster to fear than to greed. Please note how, as price begins to break through a level of support and resistance, greed usually takes the best out of a number of traders, especially aggressive traders who are very prompt to click on their respective buy buttons as soon as price begins to tick above that resistance level. All right. At the end of the day, this resistance level is probably marked on a number of different trading platforms all around the world. Okay, there are thousands of eyeballs sitting on that specific level, waiting for price to break above to score new highs, and therefore potentially signifying the continuation, the resume of that uptrend. And like I say, greed takes the best out of most aggressive traders, and they are very prompt to click on their buy buttons to jump on board once again as soon as price begins to break through. However, what happens if that breakout thrust begins to lose momentum? What happens if for whatever reason the breakout doesn't pull through? Well, price begins to retrace down, and all those buy orders that got triggered right there are now sitting at a loss. Who knows, perhaps their stop loss is now sitting down there and they are very close to be stopped out of the market. Well, guess what? All these guys are now feeling the heat because now they are losing money. Fear kicks in. This is a very important factor, guys, because this is actually the psychological trigger of the whole pattern. Fear kicks in, right? And therefore, all those guys, they are very prompt to either manually close their trades or simply be stopped out. And as a result, price plummets, price accelerates in the other direction. And in that acceleration is where we are going to make our money. Okay? Now, why does price accelerate down? Well, we all know the laws of offer and demand. All right? If demand is bigger than the offer, all right, well, basically price goes up. If the offer is bigger than the demand, price goes down. We are all familiar with these concepts, right? Well, the thing is that all those guys who were buying, who were clicking on their buy buttons as the breakout was pulling through, they were initially creating buying pressure into this market. Okay, they were buying lots of the euro against the American dollar, and they were buying, building pressure into the market. However, as those orders are closed out, as those stop losses are triggered, that buying pressure, in fact, gives way to selling pressure. Because at the end of the day, in order to reverse a buy order, you actually need to sell it back to the market. Okay, so as whenever the selling pressure overwhelms the buying pressure, price goes down. This is the very nature of the market. So as more and more sell orders are triggered right there, price simply plummets, accelerates to the downside, and that's going to be our signal to jump on board and ride that reversal acceleration for profits. Well, wow, now I do promise we are done with the theoretical stuff. I just wanted to make sure you understand why price actually behaves the way it does, all right? And hey, at the end of the day, I mean, if you're going to trade this strategy, if you're going to risk your account, if you're going to risk your hard-earned money trading this strategy, I reckon you may as well just understand why, right? You may as well understand why you took this or that trade and what's the logic behind those trading decisions, right? I just wanted to make sure that that's already out of the way. Anyway, now let's get down to the exciting part. Okay, so as price rallies up to retest that resistance level once again, we are going to be searching for one specific candlestick formation or price bar formation around breakout levels, around that level of support and resistance, in order to trigger our entry. Okay, the very specific candlestick formation we are going to search at that junction of the chart, it's what's called in the trading lingo a hammer bar. Okay, a hammer bar or a pin bar, it's basically the same thing. Okay, personally call them hammers just because they do resemble a hammer, right? That would be more or less the head of the hammer, and this would be the handle. All right, but it does look like a hammer in a way. A hammer has usually a very small body, regardless of whether it's green or red. Okay, it's just so small that it doesn't really matter the color. Okay, so at any rate, small body, a very short wick to the upside, but a very long wick to the downside. Okay, well, now in this case, since obviously we are hitting against resistance, we are going to be searching, in fact, for an inverted hammer. Right, something like that. We would be searching for a standard hammer if we were hitting a support level, meaning if price was coming from above. All right. Instead, since for this case example, price is coming from below, we're going to be searching for an inverted hammer. Okay, something like that. Okay, what's important here is to notice how price opens in this candle right there. Okay, that price candle opens right there below the level of resistance. Immediately after, within the candle, price action takes or spurs way above that level of resistance, right? It takes off, triggering all those guys who were bracketing that level of resistance. By the way, in case you don't know what bracketing a level of support and resistance means, it's basically a trading technique, a rather risky and aggressive trading technique, I must say, where you basically simply place a pending order, let's say 10, 5, 15 pips just beyond a level of resistance or support. Okay, so as price breaches through, your broker automatically fills you in the market without you actually having to wait for any further confirmation. Okay, you just leave a pending order in the market right there, and your broker automatically executes your order as price ticks above. Now, bracketing levels of support and resistance, in my opinion, is a very bad idea. It's just overly aggressive, and in the long run, you are going to be literally eaten by fake breakouts. At the end of the day, fake breakouts are about 50% of all type of breakouts. Okay, I would say that valid and fake breakouts balance each other 50-50. So in the long run, bracketing levels of support and resistance, guys, don't do it. Okay, it just doesn't work. So very bad idea. So The candle opens right there. Everybody's excited. Everybody's expecting to, it's waiting to see what type of market reaction we get around that level of resistance. All of a sudden, price shoots upwards. All those trigger-happy guys get triggered into the market. Woohoo! This is gonna be a party. We are gonna make so much money. Champagne is flowing. Blah blah blah. But boy, oh boy! All of a sudden, price turns around, the candle comes back below that resistance level, so it opens and closes below that level. It just traded above that level very shortly, but long enough to get all those poor guys into the market, and those guys are now feeling the heat. They are now sweating through their shirts because their positions are now sitting at a loss. And it's right there and right then, my friends, when fear, when mass panic takes over the market. All right? So next time you see an inverted hammer around a key level of support and resistance, with the nose of that hammer significantly breaching through that level, but failing to close above that level, meaning coming back down to close below, be very ready to trade the reversal move, the immediate next reversal move, because chances are that the very next candle is going to be in the opposite direction. Okay, it's going to be a long momentum-filled panic candle in the opposite direction, and that's right there where you've got to be ready to be rather quick, rather prompt to jump on board in order to profit from this momentum-filled reversal move. All right. So the question remains: how do we trade this reversal move? How do we make money in there? Well, let me go back into the previous slide, and as soon as you see this inverted hammer coming to a close, okay, you need to wait for that candle to actually close. So as the candle does indeed close, you go ahead and place a sell stop order a few pips, let's say 5 pips below the low of that candle right there. Okay, that would be our sell entry, waiting for the market to continue pushing down in that reversal move to automatically trigger us short in the market. What about the stop loss? Well, the stop loss depends on how aggressive or conservative you are with your stop loss policies. If you are super conservative and you'd like to give your trade plenty of breathing room, you would go about placing your your stop loss 5 pips above the high of that inverted hammer. However, more often than not, that's not really needed. Okay. Because, like I said before, the overwhelming sentiment in the market is to the downside, and therefore, very rarely price comes back to to retest the high of that fake breakout candle. Okay, in my experience, if you take the entire distance in pips of this inverted hammer and you calculate 50% of that, so that would be somewhere around there, placing the stop loss 5 pips above that 50% mark should be more than enough. Okay, so that would be your stop loss. That's a very acceptable policy. That's what I personally do myself. Like I say, it depends on how conservative or aggressive you are, but at any rate, I don't think it's necessarily needed to stretch your stop loss that way far, that far up high there. Okay, so that would be your entry. That would be your reasonable stop loss. And what about the your profit taking levels? Well, let me go back into the next slide. That would be our entry, that would be our stop loss, and as far as the profit taking level goes, I personally like to follow a dual exit approach. Okay, that means that I'm gonna exit my my trade in 2 different steps. The first step is as this first momentum reversal candle closes right there. Okay, I need to wait for the candle to close, and as it closes, I exit 50% of the trade out. So if you take the trade with, let's say, 6 lots, well, you close 3 lots right there at the close of the first candle, and obviously you leave the 50% remaining of the trade in the market, shooting for further profits to the downside. In my experience, whenever we see this type of fake breakout formation, you usually see a reversal momentum enough for 2 consecutive red candles. Okay, that's more often than not what happens. You get, like I said, momentum enough in the opposite direction to squeeze 2 different consecutive profits. So you simply wait for the next immediate down candle again, and as that second candle closes, that's where you close the remaining 50% of the trade. All right. Please note how I've pictured this second candle a little smaller, at least the body, okay, a little smaller than the first one. That's actually in purpose, because more often than not, at least in my experience after trading these patterns for so long, the second candle is usually a little smaller, a little shorter than the first one. That's because that panic momentum is fading out, the market is absorbing that fear, and therefore the down momentum begins to fade, begins to fade out, and things kind of come back to normality. All right, yes, there is enough room for second profits, but don't expect this second run to be as large as the first go. All right, now let me tell you guys about trailing your stop loss down midway through the trade. This is entirely optional. Okay, you can totally decide on whether you want to trail down your stop loss to break even or not, depending on how aggressive or conservative you are with your stop loss policies. Again, I will let you decide that. The best course of action is as the first candle closes and as you exit 50% of the trade, then take a quick look on how far your trade has moved down in profits. If you see that there is enough breathing room to trail your stop loss to break even, then go ahead and do so, and from that point on, you're obviously running a risk-free trade. You've already cashed out some profits out of the market. You can potentially leave some portion of your trade running in the market for further profits down. And if you've traded, like I say, your stop loss down to break even, then there is no risk whatsoever. Even if this candle here, instead of red, it turned out to be green and stopping you out, therefore stopping you out of the trade, well, no worries, you've still made some profits and you are not going to score any loss whatsoever on the remaining second half of the trade, okay? Like I said, it all depends on whether this first momentum candle has been long enough to give you some healthy breathing room there. There is no specific formula that you can I can't tell you, for example, if prices move down 100 pips, then it's safe for you to trail your stop loss down to break even. I can't possibly do that now because it depends on what time frame you're trading this strategy off or from, what currency pair. Some currency pairs are more volatile than others, etc., etc. I can't possibly give you a rule of the thumb here. You'll have to gauge that from a visual point of view. Again, the rule of the thumb is if you see that the distance between your entry and your first target is at least as long as the distance between your entry and your original stop loss, then that's usually breathing room enough to go ahead and trailing down your stop loss to break even. Okay, so if this distance is just as long as this distance or more, then do go ahead and trail down your stop loss to break even. If for whatever reason this first candle wasn't that long and perhaps it closed down there and therefore this distance is significantly smaller than this distance up here, then leave your stop loss where it is, or perhaps trail it down to the high of this momentum candle, or basically let's say 5 pips above the high of this first down momentum candle. All right. Again, that's something you'll have to gauge from a visual point of view. At any rate, the moment to take that decision is as you close the first portion of your trade out of the market. All right. Anyway, now that you know what the fake breakout pattern looks like, now that you know where to jump on board, where to locate your exit levels, etc., etc., you're probably wondering what currency pair this strategy works best on and what time frame. Well, as far as the currency pair goes, this is a universal pattern just like every other price action based patterns. That means that it works no matter what currency pair you trade. Okay, if you find this price formation, this inverted hammer around key levels of support and resistance, you can go ahead and trade it regardless of whether it's the euro against the American dollar against the yen, the sterling pound against the Canadian dollar. It doesn't matter. Okay, it's universal across the board. However, when it comes to time frames, I would totally recommend you to stick to the longer time frames. I'm talking about the daily, the weekly or the monthly time frames, and therefore daily, weekly, or monthly candles, right? How is that? Well, because like any other price action strategy that's based mostly around candlestick formations, it's just more reliable in the longer time frames. The longer time frames are more, not only they are more reliable, but also they are more steady. You see, the intraday charts are, you can totally trade them. They are just as profitable. The problem is that for candlestick formations, is that there is just too much random market noise going on in the shorter time frames. I'm talking about the 15 minutes time frame, the 30 minutes time frame, the 1 hour time frame, etc., etc. There is just too much market vibration, so to speak. Because, like I say, intraday price action is a little bit more chaotic than in the longer time frames, right? So therefore the candlestick formations are not so clear, they are not so reliable, and well, your win-loss ratio in this type of candlestick patterns is going to be significantly worse than if you trade them exclusively on the daily, weekly, and monthly time frame. Okay, that's my advice, guys. Trade it on any currency pair, but only on the longer time frames. Anyway, before I end the theoretical part of today's session, I'd like to again remind you of the breakout candle, because that's the key of the entire thing, both for fake breakouts and valid breakouts. It's super important that you are patient and that you wait for the breakout candle to actually close, okay? Because depending on the shape of that breakout candle, you will be able to determine whether we are facing a fake breakout or a valid breakout. If instead of seeing this type of inverted hammer, you see a momentum breakout thrust where the candle is actually a full body candle, where the wicks of the candle are very short, but the body of the candle is long, is full, is thick, and it's green, all right, closing closing way above breakout levels, then chances are that this is going to be a valid breakout that's taking place in momentum, that's carried out in enough volume to, basically cast away any potential fear in the market, right? It means that the greed in this market is too strong and it's just pushing forward. So if you see this type of breakout candle, chances are that you are going to see a continuation swing in the very near future. All right, so again, I must repeat, be very patient whenever you see a level of support and resistance, and whenever you are dealing with breakouts around levels of support and resistance. That's why I said before that you don't want to jump on board and bracket that specific level way too early. You want to be patient, guys. You want to wait for this specific candle to close just to read whether you're gonna get the hint, okay, whether you are going to get a signal for a fake breakout or for a continuation breakout. All right. What else? Oh yeah, a little word of warning, guys. Remember that this entire strategy is based on mass panic, okay? On fear becoming the predominant market sentiment, right? Well, if that fear doesn't kick in as soon as possible, then chances are that the fake breakout setup is going to fail entirely. So, if you see that, let me go into this slide. If you see that by the time this fake breakout candle right there closes, and obviously you go about pending, placing your pending sell order in the market, well, if you see that the next immediate candle doesn't quite trigger your pending order, then be very careful there. If you see that perhaps over the next 2-3 candles, price simply butts around, flatlined around breakout levels, it means that the market is undecided. Okay, all these are confusion, hesitation candles, right? The market is not yet decided whether it wants to pull through or whether it wants to reverse. And here's my question to you guys. If the market is not ready to take off, how are you, as an individual trader, how can you possibly be ready yourself to take off? It's just impossible. Remember, guys, we individual traders are not market leaders. I'll repeat that, guys. We are not market leaders. We are only market followers. That's why I said before that it's very dangerous to simply bracket levels of support and resistance, because if you bracket a level, you are assuming that you can jump ahead of the next market move. And that's impossible, guys. The only market leaders in these games are hedge fund managers, the guys working for Morgan Stanley, for Goldman Sachs, for big investment banks, even for the guys working for central banks, right? Those are the guys who move the market. You or me or any any of us, any individual trader cannot move the market. And if we cannot lead, then we just have to follow, right? So if the market is not giving us any clear market bias, then we don't want to trade because we cannot lead. We can simply follow. That's our job here. Don't take it wrong. There is nothing wrong with following if you are following the money, right? Well, that's what you want to do. You want to follow the money. You don't want to lead the way. All right. So at the very most, what I usually do is give it one candle of breathing room. If my pending sell order is not triggered on the second candle, right? That would be, sorry about that. That would be, sorry, I'm messing my entire thing here, moving the slide presentation. If my order is not triggered by the second candle after the fake breakout, right there, okay, that would be the massive red candle we were talking about before. If that doesn't happen, then I simply go about manually closing out, or actually manually canceling that pending order. Okay, if price simply bats on flat lines around breakout levels, you know what? I'm out of here. I don't want to trade that fake breakout because that's not a fake breakout anymore. Now, that's just a hesitation breakout, and that's not the kind of stuff we are trading here, all right? And now, before I forget, there is just one single exception where it's okay, there is no problem at all if we delay our entry a little bit longer, all right? And that's when, if instead of getting this type of, hesitation candles, we get another fake breakout candle, okay? That's totally okay. The fake breakout setup as a whole remains intact. Okay, everything remains in place just as usual because this second candle reinforces the first one, as long obviously as this second candle follows the same principles. Price opens below breakout levels, then it takes off, but immediately after it comes back down and actually closes below breakout levels once again. So all in all, we are simply repeating the same pattern, right? And as a whole, like I say, the fake breakout setup remains in place, and there is no reason to believe that the next immediate move is not going to be that mass panic downswing that we were talking about before. All right? So as long as this second candle is pretty much another fake breakout candle, giving us in fact a twin fake breakout candle formation, then the fake breakout strategy, the fake breakout setup as a whole remains totally valid, and therefore we are to trade in the same way. The only difference is that we are going to adjust our pending order as per the second candle instead of as per the first one. So we would simply get our pending order and we would manually adjust it to be placed 5 pips below the low of that second candle, and pretty much the same thing for the stop loss. Okay, we would calculate 50% of this entire distance and place the stop loss few pips above that 50% mark. Okay, so basically we are simply delaying our entry one more candle, knowing that the setup as a whole is still valid. Anyway, I believe we've covered pretty much all the theory. Man, it's already been 45 minutes into the webinar. I gotta learn when to shut up already. So I'm going to stop now talking about theory. We are gonna bring some actual Forex charts on the table, and we are gonna find those fake breakout setups in actual Forex charts. Just one second, guys. I got a mess here. I'm trying to drag my charts from the other monitor. Oh, there we are. Okay, so we are looking into the euro against the American dollar, monthly time frame, very long-term outlook here. This is a beautiful chart, actually. Take a look at those harmonic price swings. I love when price is giving such a clear price pattern. It's so much easier to trade, so much more beautiful to look at, isn't it? Anyway, so price down here gave us a very nice rundown. Back then, printing what was back then indeed an absolute bottom, okay? And whenever we see these clear swing points, we are to mark it with a level of support and resistance. Support in this case. So right there we draw our our horizontal line. At any rate, price bounced up off that level, it gave another chance, another shot at that level, and take a look at the price formation. At the price reaction, we got around breakout points, breakout levels. Do you recognize this candle formation, guys? Isn't that the prototypical fake hammer breakout formation? This time around is not an inverted hammer, okay? Because we are now looking for a fake reversal to the upside, but at any rate, the principles, the core of the pattern is exactly the same. It's a fake hammer breakout formation with a very tiny body, okay? That candle has a very tiny body, also a tiny wick to the upside, but at any rate a very long nose to the downside, certainly breaching through that former level of support, and I can assure you, certainly triggering a number of sell orders right there. You know, those guys bracketing the level of support, those guys overly aggressive, looking to jump on board out of greed, thinking that this move was going to continue, but as it turned out to be, price reversed and it closed above breakout level right there, okay? Well, guess what? All those guys who got triggered right there were now sitting at a loss, probably thinking over and over why the heck did they take that order. At any rate, probably either manually closing their trades in panic or simply being stopped out by their respective stop losses. As a consequence, as a result, the typical fear-induced reaction, a momentum, huge, enormous momentum candle in the opposite direction. Do you guys see this enormous momentum candle with a full body, okay? Full body, very tiny wicks both up and down. This is the prototypical fear candle after a fake breakout formation. Okay, prototypical stuff. So, how do you trade this thing? Well, as the fake breakout candle closes right there, you go about, obviously you recognize that this is indeed a potential fake breakout, and you go about placing a buy stop order 5 pips above the high of that fake breakout candle. Okay, stop loss, simply measure the distance for this entire candle, mark the 50% range somewhere in there, and the stop loss would be a few pips below that level. Right there is where we would place our stop loss. Okay, the next immediate candle triggers our pending buy order, and well, it cruises north. Just the way we like it, isn't it? That candle closes right there. At that moment, we close out 50% of our trade. All right. 50% goes back into our pocket, lovely stuff. And what about the stop loss? Do we trail it? Well, that's our entry, that's our stop loss. Since the distance between the entry to our first target is certainly larger than the distance between the entry and the stop loss, or at any rate more or less the same distance, I reckon we have breathing room enough to trail the stop loss to break even. So at this point, we have some money in our pockets. We can take our respective lovely ones, beloved ones, to a nice dinner at a fancy restaurant, and at any rate, we can sleep tight at night because we know that the remaining 50% of the trade is entirely risk-free. Our stop loss is now set to break even. Anyway, here's where things quite didn't work out as expected, or at least not as per the textbook, right? The second push, as I said before, you usually see momentum enough, panic enough for a second push in the opposite direction to the fake breakout. Well, that second push actually took a little longer to take place. There was a little bit of a hesitation, or at least a little bit of a pullback before that second push took place. You see this second nice momentum candle, all right, in this direction. Very nice second candle. It just took a little longer to pull through. Hey, that sometimes happens, all right. But at any rate, since your entry, since your stop loss was sitting at break even, it was totally okay to simply let it ride. Okay, let it, simply wait it out, wait for this hesitation candle, waiting for that potential second push to come in place. Depends on whether you decided to close the trade manually at the close of the second candle, or like I say, whether you decided to simply wait it out now that you are riding a risk-free position. So hey, why not taking your chances? If you manually closed out your trade right there at the close of this second candle, well, you still made some little profits on the remaining 50% of the trade. If you wait it out and just waiting or hoping for that second push, you certainly cashed out some very nice profits as well on the second push. Okay, these many pips right there. All right. Either way, this was a successful, a profitable trade altogether. All right, so here, as you can see, these fake breakouts and as the consequent panic reversals do take place both to the upside or to the downside, as we've seen through the tutorial slide presentations. All right. We saw, just one second, we saw a similar formation on the sterling pound against the American dollar, this time around on the weekly time frame. Take a look at the price swing structure: swing down, support, up, down, support, up, down, up, down. Right there we had a support there, but at any rate we already had a double bottom support in there. Let me actually just compress that and draw a line in my chart. There we are. Just a second, I'm drawing that line there. There we go, more or less in there. All right, so support, price tested that support level in this candle here. Do you see that long candle there testing this specific level? Well, price simply failed to push through on that one, but then it finally had another attempt. You see that one there? Well, that's a fake breakout candle, even though this is not the most beautiful one, because actually the body of the candle is too far away from breakout levels, okay, and the nose of the candle doesn't quite break that far down through the support level. The farther down it goes, the better, because that means that more traders are actually tricked, are actually, basically more sell orders are triggered into this fake breakout, and therefore the reversal is going to be much stronger, because more people are going to fear losing their money, and therefore they will close and reverse their positions as price turns up. Okay, so again, as a general rule of the thumb, the longer the nose of the fake candle stretches through the support line, the better. All right. More people being faked out. Hey, so a little bit of a fake breakout there. Price came back up to close above. You see the tiny body of that candle there. Entry point would have been just a few pips above the candle right there. The close of the first portion of the trade, and right there, close of the second portion of the trade. Now, just because entry point was too far away from breakout levels, I wouldn't have taken this trade. You see, at the end of the day, you have to remember that the closer you manage to nail your entry, just above fake breakout levels, the better, the most, let's say, the more optimal your entry is. If your entry is just too far detached from that fake breakout level, it means that price has already traveled quite a lot away from there, and who knows, you may not get that much panic momentum in that direction. This time around we did, okay, we did get actually 3 consecutive panic candles. Well, yeah, that's good. all good and dandy, but that's not always the case. So if you see that by the time the charts give you your entry, you are already too far from breakout levels, well, an indication that perhaps, just perhaps, you may want to pass on this specific trade, okay? Whoop. There we are. All right, so we are looking into the American dollar against the Canadian dollar. This is the loonie, by the way, in case you don't know. The American dollar against the Canadian dollar in the Forex lingo is known as the loonie, just because it's a little crazy, okay, a little chaotic price action occasionally. Anyway, we are looking into the weekly time frame. We can see the prototypical double top in there, okay, prototypical double top in there. From there, price gave us a very beautiful down run, okay, beautiful move to the downside, you know, a healthy downtrend at the end of the day. However, here a price printed a an absolute bottom. Whenever we see the top, a significant top or bottom, we are to mark it with a horizontal line as if it was indeed a key level of support and resistance, right? Well, from there, price bounced up and immediately after, actually, it came back down to retest this level once again. Do you see that? Well, you recognize that, guys, as usual. As I've been showing you all along, that's a prototypical fake hammer formation. All right, you see how this long nose breaching through this former level of support, potentially triggering a number of sell orders. Okay, now the interesting part of this specific chart is that we got some kind of a double twin hammer formation. Do you see that? Okay, both of them follow more or less the same pattern. This candle opens there and actually plummets all the way down there, like I said before, triggering a number of sell orders. It comes back up to close above, right there, above breakout level. Then we have another candle that opens, if I'm not mistaken, right there. It goes down once again, and eventually it pulls back up above breakout levels once again, and right there is where it closes. So effectively we have two consecutive candles giving out the same type of price pattern, okay? Effectively the second candle is reinforcing the first one, and well, you know what we are to do. If we had already placed right there at the top of the first candle a pending buy order, well, we were simply to reschedule it, or rather to readjust it to the just immediately above the high of the second candle. Right there is where we get triggered, and take a look at this beautiful panic candle. Okay, again, prototypical panic candle, as all the guys who got faked out here begin to close their trades in a rush, price accelerates in the opposite direction. Okay, beautiful prototypical candle. Unfortunately, we didn't get that much of a reaction on the second candle, probably because the previous one, the first one, was already way too long. All right, so there was not that much panic left in the market. Okay, things do tend to calm down eventually, and as you can see, over the following candles, price action slows down. All right, slows down up there, just because, like I said, this one was already way too big. But hey, well, what does it matter? You already got your profits at the close of the first candle, so that's not too bad. If on the second candle you hardly get any extra profit in there. All right. Guys, prototypical stuff with the particularity of having a double fake breakout candle there. Whenever you see that double fake breakout formation, make sure to be very ready to trade in the opposite direction, because this is a high probability, very high, very reliable pattern, okay? And like I say, high probability that the next immediate move is going to be in the opposite direction. Be ready to trade it, all right? All right, the Australian dollar against the American dollar, weekly time frame as well. Support, support, in fact almost a double bottom, almost both levels at this both price lows, swing lows at the same level. Okay, we can effectively draw a level of support and resistance, at any rate rather significant, since both of them are more or less in line. Okay, and oops, sorry, that's not a straight line. Let's not get slopey with our levels of support and resistance. There we are. All right, so recognize that, guys, recognize that. All the way up. Very nice trade. Now, take a look at there. Bounce of that level of support, like I said before, almost effectively shaping up as a double bottom. Nice rally up, absolute top, reversal. As an absolute top, we are to mark it as a level of resistance. There we are. Now, recognize that. Down it goes. As you can see, these type of patterns happen recurrently. All right. Remember what I said before, that almost 50% of all breakouts eventually turn out to be a fake breakout? They do happen, guys. They do happen recurrently in the markets. And if you master this technique, you are going to get a number of trading opportunities over and over and over and over. And the most beautiful thing of all is that they give out such a beautiful run. All right, take a look at those enormous panic candles. Don't you love mass panic? Don't you love fear? You've got to if they give out such a beautiful run, where, you know, obviously you can totally profit from. All right. There we are. Euro against the Japanese yen, weekly time frame, prototypical stuff. Let me actually zoom in a little bit more. So beautiful downtrend, right? Didn't it? Eventually giving us an absolute bottom right there. Who knows? Perhaps if we extend that line, next time price comes back down to pay a visit to that level once again. Hey, like I say, who knows? We may get a fake reversal. However, remember when at the beginning of this video I told you that this type of fake breakout formations happened not only on horizontal levels of support and resistance, but also on trend lines? Well, take a look at that beauty down there. Like I said before, we were going through a very nice downtrend in price action, right? Well, let me draw that trend line linking this swing high and that one. Let me extend that out in time. There we are. So, do you recognize that pattern there? Isn't that a fake breakout inverted hammer? Price breaching through that outer trend line, probably triggering a number of orders, a number of reckless orders, I should say, on the way up, and eventually turning back down within the trend once again. All those guys who were betting for the for the breakout at this time are now sitting at a loss, and well, as a result, a counter trend move, counter breakout move. Okay, in this time around in the direction of the former trend, since the breakout didn't eventually pan out. Okay, fair enough. I would not say that this is a very exciting panic reaction. The market didn't quite panic there very much, perhaps because not many orders got triggered there. Like I said before, the more orders get triggered on the fake breakout, the stronger the counter breakout reaction actually is. Okay, so if not many orders got triggered there, then you will not see a super run in the opposite direction immediately after. All right, well, at any rate, the pattern is still valid. Okay, price opens there, rallies up, comes back down, closes down there, and market reaction in the opposite direction. So like I say, the pattern is still valid. It wasn't just a very exciting one. Okay, but at anyone, profitable, and hey, why not make some profits out of fake breakouts also whenever they happen around trend lines. Anyway, fellas, I would say that's about enough, okay? I think by now you probably are fed up already with the fake breakout thingy. You should now have a clear understanding of what the fake breakout strategy looks like, how to trade it, how how you recognize it on your charts, etc., etc. Okay. And well, anyway, if you would like to learn more about the fake breakout strategy, I can only refer you to my mentoring program, where I do indeed teach the fake breakout strategy and dozens more. Okay, and that's literally dozens more. Okay, there's just so much information in the mentoring program that it's not even funny. Now, before drilling down into the specifics, I would simply like to ask an open question to you. Why? All right, as simple as that. Why do you think some traders make it in Forex whereas some others don't? Okay, why do you reckon some traders eventually turn into winning traders whereas some others unfortunately remain as a losing trader for good? Well, there are a number of reasons as of why that may happen. You see, I think what's important here is to understand the difference between winning traders and losing traders. In one hand, winning traders realize that Forex is not a game, and this may sound totally obvious, but you will see why it's important and why it's not that obvious in a second. Instead, they understand that in order to profit from Forex, they need to actually learn how to trade. And this is the key idea that I want to, well, simply bring your attention to learn how to trade. You see, learn how to read the charts, how to read price action, how to apply sound money management rules, and all in all, and this is also very important, to be responsible with their trading, okay? To prove that they are serious about their Forex trading. In the other hand, losing traders unfortunately believe that commercial products will make consistent profits for them. All right, I'm talking about, automated Forex trading robots, black box trading systems, that kind of stuff, okay? The kind of stuff that you may download from an internet forum, or perhaps you may buy it for, I don't know, $97 on the internet, etc., etc. You know what I'm talking about. Okay, basically they think that, or they actually don't want to study the charts. They don't want to have to think as a trader. Remember what I said before, that you have to actually learn how to trade, and that obviously implies that you need to think as a trader. Okay, think, key word in there. All right. Unfortunately, losing traders want to know nothing about that. All they want is to simply follow an easy ABC blueprint, click a few buttons, and magically take profitable trades on a daily basis. Okay, because they don't want to take the effort. They don't want to go the extra mile to truly understand what this game is about. All right. Now, I'm going to explain what I personally call what's the losing traders loop. All right, and before I get started, please, I'm not trying to be offensive here, so if I may sound offensive towards new traders, or perhaps traders who've been in this game for a little while, but the people who can't reach consistency in their trading, like I say, I'm not trying to be offensive here, and if I do sound offensive, I do apologize in advance. All right, I just want to simply come out clean and explain how things truly are. All right. Now, what is the losing traders loop? Well, first of all, most new traders, or people who are searching for a solution to their losing habits, usually they start off via the internet forums. They go to an internet forums where a number of people simply post away their opinions on Forex, on trading systems, etc., etc. And while the internet is a beautiful thing, all right, because everybody shares their opinions and everybody posts their advices and recommendations, the truth is that no one filters that information, okay? And people posting away in those internet forums, people posting away their trading systems and, their techniques, etc., etc. The truth is that the majority of them, they don't really know any better than you, all right? They're just people who are trying to figure out this game. They try to bunch up with some other traders, and somehow as a communal effort trying to fight their way through. All right, therefore all the or at least the large majority of all the different trading systems, trading opinions, recommendations that you may find on public internet forums are simply misleading. All right, I'm not saying that people do that on purpose. It's the way the internet works. Okay, everybody is sharing their opinions, but 90% of them is actually wrong, unfortunately. Okay, so after having tried a number of trading systems shared around the internet forums, and unfortunately after having gotten nowhere with any of them, probably the next step is to, simply try what I call a black box system. Okay, like I said before, perhaps an automated trading robot, perhaps a combination of magic indicators that, for whatever reason, were combined together, are supposed to provide fantastic trading results. Well, the problem with these black boxing systems is that they don't really tell you the logic behind those indicators. They don't tell you why you combine this or that indicator. Okay, they don't explain why price reacts to those indicators, or rather, actually more accurately, why indicators react to price in any given way. Basically, you are trading blindly. All right, they simply tell you what you have to do, but they don't tell you why. All right, now here's my question: if you are to risk your money, if you are to risk your account, will you really rely and trust on a system that doesn't really explain the logic behind its trading decisions? I mean, I don't know about you, but I sure know that if I am to bet my money on the markets, I want to know why. Okay, and you usually don't get that whenever you're getting access to a black box system. As a result, well, neither the internet forums or black box systems actually provide any consistent results. Okay, unfortunately, no matter how hard you try, no matter how long you try those systems for, the results are just not there, and then you enter what I call the loser's loop, which basically means that after having gone through this process and after having gone nowhere, you go back into the internet forums, sharing your experience and trying to get some advice, some guidance for other guys that, like I said before, they are going through the loser's loop themselves because they don't know better than you. All right, and hey, who knows, maybe you may download some other combination of magical indicators, perhaps you may buy another black box system, etc., but the results they process eventually always ends up in the same way. No results, keep on feeding the hamster wheel and having the whole process restarted over and over again. All right, now I'm going to ask you a few open questions. I'm going to try to be as honest as possible, and like I said before, I hope I'm not coming across as being offensive or too blunt. I'm just trying to be honest here. All right, so I'm going to ask you to please honestly answer the following questions as well. Have you tried a number of different systems as of lately? Again, it doesn't matter whether you downloaded them from internet forums or whether you purchased them as a black box system. Okay, doesn't matter, right? Have you tried a number of different systems as of lately? Are you still perhaps not finding consistency in your results? All right. Moreover, have you used or tried multiple combinations of indicators that you don't know how they operate, you don't know why you combine them together, but they're just supposed, for whatever reason, to work fantastically well when put together in your chart? All right. Are you still not quite sure what actually moves the markets? I mean, do you ask yourself why trends exist? Why trends come to an end? Why price eventually, becomes rather stagnant and flatlined, and afterwards we usually see a momentum breakout in either direction? Do you ponder all this kind of stuff? Do you try to understand what moves the market and why price behaves the way it does? And moreover, when a trade goes wrong, are you still confused as of why it did indeed go wrong? Do you understand when a trade goes wrong, what was the problem? Okay, what failed in that trading setup? All right, well, if the questions to these answers are yes, then unfortunately, make no mistake, you are still in what I called before day losers loop. All right. Now, the question remains how to escape from that losing trader's loop. All right. What can you do in order to exit that hamster wheel? Well, first of all, my first advice, come back to the basics. All right. Start thinking as a trader instead of as a system follower. You need to understand your system, okay? Start forgetting about automated forex robot, forget about black box system, about magical combinations of indicators that you don't understand. You need to start thinking as an actual trader, all right? Not as a system follower. Forget about the system, or actually forget about following blindly a system, any system, it doesn't matter. You need to start understanding that system, okay? And point number 2, it's very important you realize that successful forex trading is mostly an analytical activity. Okay, it relies more on statistics and ratios than on ultra complex systems and colorful indicators and whatnot. Okay, it's not about the system, guys. It's not about the indicators. It's all about statistics, ratios, etc., etc. Because, like I said before, it's an analytical activity. Let me give you an example. Well, let's imagine that after this quick presentation, I teach you a price pattern, a repetitive price pattern that happens over and over and over in the forex markets, and that provides on average a 60-40 win-loss ratio. Okay, every 100 trades or every 100 times you trade that specific price pattern, 60 times it's a winner, 40 times it's a loser. Now, let's imagine now that I teach you some money management mechanisms to, apply a, let's say, a 1.5 to 1 risk-reward ratio on your trades. That means that for every dollar you risk, you aim for $1.5 in return, right? So here, basically what you have is a system or a price pattern with a positive statistical expectancy, because you just need a 60-40 win-loss ratio weighted at 1.5 a risk-reward ratio, and there you have it. In the long term, statistics, the data, will lean on your side, and as a result, your equity curve in your account will be steady, slow, but steady, pointing upwards. Okay, and that's what a healthy equity curve actually looks like. I'm sure you've read on multiple forums, black box systems, etc., etc., stuff like, I don't know, 98% win-loss ratio. Well, guess what? That's BS, guys. And again, I'm sorry if I am being blunt here. All right, it's absolutely impossible to sustain any ratio anywhere near that. In fact, most professional traders are around 60-40, perhaps even 55-45, 65-35 is already a very good ratio, but combined that a positive expectancy with, like I said before, a positive risk reward ratio, that makes it that in the long term, well, there you have it, your healthy, upwards, slow but steady equity curve. Okay, so like I said before, start thinking in terms of statistics and ratios rather than ultra complex systems and indicators. All right? Now, if I was to come up with a quick blueprint for long-term forex success, I would necessarily have to describe 4 main pillars. All right? Pillar number 1, you need a sound, solid, no-nonsense, real-world trading approach. Okay? Again, forget about black box systems, forget about automated trading robots. None of that. You need a real-world trading, real-world trading techniques, trading strategies that actually apply to real-world trading conditions. Okay? Then, pillar number 2, you need the appropriate tools. That means to avoid stuffing your charts with useless indicators. Sure, they may look colorful, they may sound cool once you put them in your charts, but quite frankly, they are pretty useless. You are not going to extract any useful real-world information out of those indicators. All right, they are just going to get you confused. Get rid of them. Okay. Next, pillar number 3, and this is perhaps optional, but absolutely useful. You need guidance to simply speed up the learning curve. And while there have been some traders who, basically found their way through all the way from scratch to the top of their game, obviously the learning process is just much longer. All right, a little bit of a guidance from someone who may have a little bit more of experience usually helps, okay, cutting down on that learning curve. And pillar number 4, and perhaps this one is the most crucial of all, you need to take your trading seriously. Okay, and this is what no one wants to tell you, but unfortunately it is true. You need to actually take these things seriously because, hey, let's face it, trading forex is not that easy. All right, there are a number of variables to take into consideration, and while anybody can potentially turn profitable as a trader, there needs to be a little effort coming from you. Okay, it's basically like learning a language. Anybody can learn any language, really. All you have to do is to take some classes, perhaps sit down and do your homework, perhaps listen to some tapes, do a little bit of conversational classes as well, etc., etc. Basically, you need to take it seriously, and if you do, you will eventually, obviously, learn the language. Well, trading forex, or rather becoming proficient at trading forex, is not really different. It's possible, but it takes some effort from you. Now, I hope you understand that as far as pillar 4 goes, which is taking your trading seriously, that's 100% up to you. I can't help you there. Either you are serious with your trading, either you want to go the extra mile, either you want to put in the effort or not. That's, like I said, that's entirely up to you. However, I can indeed help you with pillars number 1, number 2, and number 3. And that's again, to provide you with a sound, solid, no-nonsense, real-world trading approach, all right? To give you the appropriate tools, all right? Not the useless indicators that you may be used to, actually to provide you stuff that actually works, all right? And finally, a little bit of guidance to speed up the learning curve, okay? Those are the 3 pillars that I can totally help you with. So, here's my proposal. If you promise to take a serious effort in your forex trading, okay? If you promise that you will treat your trading seriously, well, then I promise to help you becoming a successful trader. Okay, that's my promise to you today. And if that sounds like a fair deal to you, then I would be delighted to invite you to my private forex mentoring program. Now, let me firstly review all the contents that you will find within the mentoring program, okay? First of all, it's a DVD-based program, all right? All in all, there are 6 DVDs, and in total, over 100 videos within those DVDs, right? So if you like my Forex videos and my Forex lessons, you're gonna find plenty of them within the program, all right? Now, you're probably familiar already with my teaching methodology. Firstly, I usually like to outline the theory behind any particular price pattern or trading technique or system altogether that I may be teaching you, okay, just to make sure that you actually understand what we are trading here, okay? I like you to know not just the how you trade it, but also the why you trade it, okay? What's the logic, the core principles behind any particular trading technique, okay? I believe it's very important that you understand both sides of the coin, not only the how, but also the why. And then, when we've covered the theory, then I actually go about explaining or showing you live trades where I apply those theoretical concepts into live forex charts. And I actually mean live, as as the current price is ticking on my trading station. Okay, basically what I do as I conduct my standard trading activity, I enable my screen recording software and I command all the way through the process, okay? How I go about scanning different charts, searching for my trading opportunities. Then when I find an opportunity, I explain you the exact reasons as of why I like that specific chart, okay, for that specific moment, just so you understand how to find trading opportunities yourself. Then I go about explaining where exactly I enter the trade, where I position my stop loss level, my profit taking level, where I trail my stop loss to break even and why, etc., etc. Basically, I show you the whole process as the chart is ticking live. In my opinion, firstly, reviewing the theory behind a trading approach and then seeing that specific trading technique applied in live ticking charts is just the best the best teaching way, because it's like if you were looking over my shoulder, okay? It's like if you were sitting on my trading desk next to me and I simply explain all the way through the process over a number of live videos, not just one, not just two, but actually you will find many trades recorded live. So once you see how I go about trading those repetitive patterns, you can actually apply the same process onto your own charts, all right? Anyway, the mentoring program, like I say, it's based on modules, each module being one DVD, all right? And I would like to cover all those individual modules, just so you know the specific trading systems and techniques you are going to learn. In the first module, you're going to learn the 3 SMA system. All in all, you're going to find 21 videos and 6 live trades within this module. Okay, now the 3 SMA system is a trend riding system. Basically, it's going to teach you how to trade whenever we are in a trending market condition, right? You know, they say that the markets trend around 30% of the time, all right? And well, the 3 SMA system is going to show you how to find, how to spot healthy trends all across the board, okay, and how to exploit those trends for as long as it lasts. All right, now trends is a universal price pattern, okay? It applies to any currency pair and any time frame, and that means that you can indeed trade the 3 SMA system on any currency pair and any time frame. Now the beauty of this system is that since you can apply it on a number of different options, both currency pair wise and time frame wise, you're gonna find so many trading opportunities, because at the end of the day, somewhere out there in some currency pair and in some time frame, you will always find a solid trend to ride, okay? One day you're gonna trade this system on the, I don't know, let's say the sterling pound against the American dollar on the 4 hours time frame. Then the next day over, you are gonna find it on the Swiss franc against the Japanese yen on the daily time frame. And then the next day over on the euro against the Canadian dollar on the 15 minutes time frame, right? So this system applies regardless of whether you are an intraday trader, a long-term trader, etc., etc. You will always find at least 2 or 3 trending conditions on some currency pairs, some time frames, and that wide range of options is going to always allow you to find trading opportunities almost on a daily basis, okay? The system, or along with the system, you will find the 3 SMA Trend Wrapper Custom Indicator. Now, this indicator has been specifically coded for me by my personal programmer. You know, basically allows you to identify where trading conditions, where solid trading conditions apply, and how to maximize your profits within those trending markets. Okay, let me actually give you some examples. Okay, take a look at this chart here. This is the Canadian dollar against the Japanese yen 1 hour time frame, and well, we can certainly see how this is indeed a solid trending market condition, right? The trend wrapper indicator will plot here at the bottom left corner of your chart a trend filter. Okay, basically it's going to analyze this specific currency pair on all time frames: the 5 minutes time frame, the 15 minutes time frame, the 30 minutes time frame, the hourly, the 4 hours, the daily, and the weekly. All right, so basically all the way from the intraday charts to the medium-term charts and the long-term charts, right? And it's going to analyze this specific currency pair in order to spot whether there is any specific time frame where a solid trend is to be found. Do you see this green circle there in the 1 hour time frame? That indicates that on the 1 hour time frame there is indeed a healthy trend, and therefore well, it's a trend that we can ride for profits. And as you can see on this specific currency time frame, well, we do have indeed a trend, right? So once the indicator finds a trend on any specific time frame, it draws on your chart, it plots what I call the dynamic areas of the dynamic wrapping areas for that specific time frame. Okay, take a look at this chart. Here we can see this lower area, this lower band below the trend. Okay, and here we can find this upper band just above the price action, right? Well, this is what I call the dynamic area of support and resistance, and this is what I call the dynamic area of exhaustion, right? Like in any other trend, price moves in a zigzagging fashion. Okay, push up, retracement, push up, retracement, push up, etc., etc., for as long as the trend remains in place. Once the trend breaks, this this little green circle will disappear from there, and well, basically that's your signal to stop searching for for trades within that trend. As long as that green circle is in there, you can continue searching for your trades within this trend. So how does this system operate? Well, basically it marks you the areas where you want to buy into this trend. Okay, since this is obviously an uptrend, you want to buy into it, and that's the area of the dynamic area of support and resistance. This area here, this is the dynamic buy area. Whenever price retraces down here, that's where you want to buy. Okay, and as you can see from there, a price takes off for a whole new swing until it reaches the area of exhaustion. These are the levels where you want to exit the trade. Okay, by the way, the indicator automatically plots this line because it dynamically reads price action. It dynamically reads the projection areas where price may simply fall out of steam and therefore retrace back down, and that's why at that area is where I advise you to exit the market. Okay, and then wait for a whole new retracement. Price comes back down to the buy area, you buy in there, let price take off to the exhaustion area, sell, exit there, so on and so forth. Price retraces, pulls back down once again. Here is where you buy, here's where you cash out those profits, etc., etc. And down here you will see the point of no return, the point of where if you enter any trade there and there and there, and if for whatever reason the price doesn't quite take off in your direction, well, this is the level where you want to exit the trade. Okay, but at any rate, it basically marks absolutely everything: entry levels, exit levels, stop loss levels, etc., etc. Anyway, let's now take a look at this second chart. This is the Australian dollar against the American dollar, 30 minutes time frame. So as you can see, you can find this type of setups on different currency pairs, different time frames, etc., etc. This time around, the indicator it's calling again on the 30 minutes time frame. It's printing a red dot, right? That means a downtrend. Okay, green dot as before. It's an uptrend, and therefore the area to buy or sell prints in blue because it's obviously a buy area. On the other hand, if we are going through a downtrend, the sell area prints in red. Okay, just to make sure you don't get confused. So downtrend on this specific time frame. Whenever we see a trend, the indicator automatically plots both the sell area, the sell band, and the exhaustion band. Do you see this exhaustion band here? All right. So, well, what are we to do? Well, we are to wait for price, like in any other trending, swinging structure, to simply come back to the area, to the sell area right there, sell into this downtrend, ride it all the way to the exhaustion level, and then wait for price to retrace once again, load short in this trend right there, wait for price to take off to the exhaustion area once again, then wait for another pullback for our next opportunity, and then let price take off on a whole new swing until the exhaustion band once again, right? So all in all, as you can see, you can find multiple trading opportunities within a trend, right? That's the whole point of the 3 SMA system, to ride a trend for as long as it goes, right? For as long as it continues pushing in one single direction, in this case to the downside. Now, that doesn't mean that you are to enter short at the beginning of the trend and then ride it all the way to the end in one single position. That's not the way the system works. The way the system works is to trade individual swings within the trend. Okay, so you would trade this swing, then you would sell once again there, you trade another swing, trade, exit, and so on and so forth. So you would be actually monitoring one single trend, potentially looking to enter multiple times within that trend. That's why, or that's how you actually maximize your profits, as long as the trend keeps on pushing in your direction. Now, let me give you another example, this time around the euro against the Canadian dollar. As you can see, it's a whole different currency pair in the 4 hours time frame. Again, a whole different time frame as well, right? Universal patterns apply on every currency pair and every time frame. This time around, the indicator is calling for an uptrend on the 4 hours time frame with that beautiful green dot in there. And as you can see, we are indeed going up in an uptrend for this specific time frame. As a result, the indicator draws both the dynamic buy area and the dynamic exhaustion area. All right, and what we are to do as trend riding traders is to wait for price as usual to come back down to the buy level, load up into this trend right there, ride the swing all the way to the exhaustion point, exit out the trade there, then simply wait for another pullback, which always comes, then load up, ride, exit, wait, load up, ride, exit, and so on and so forth. Okay, for as long as the trend remains in place, you are to simply follow exactly the same approach. Trends are repetitive patterns. If they repeat themselves over and over and over, why wouldn't you try to make profits trading the same pattern, the same swinging pattern over and over and over? Okay. By the way, this buy area and exhaustion area are dynamic. The indicator actually every live tick, the indicator recalculates price action and dynamically adjusts both the exhaustion and the entry area. So, for example, if price begins to gain momentum and the swings become wilder, longer and longer, right, it will automatically reflect that and it will stretch out the exhaustion level perhaps up there, okay, at any rate, and the entry point from there down here. So at every tick, the indicator recalculates its algorithm, and therefore it adjusts the optimal entry and the optimal exit level in real time. All right, every single tick, it tells you the optimal area to enter and the optimal area to exit the trade. Okay, the next module is the London Open breakout strategy. Here you will find 20 videos and 7 live trades. Okay, now this strategy is mostly based around momentum breakouts in the early London session. There is a good reason as of why we base our entries around the early London session, and you will see why in a second. Now, this strategy is to be applied only in euro and sterling pound crosses, such as the euro against the Japanese yen, the euro against the Canadian dollar, the euro against the American dollar, or the sterling pound, the sterling pound against the Swiss francs, sterling pound against the Australian dollar, against the Japanese yen, etc., etc. Anything that's got to do with either the euro or the sterling pound. And this is to be traded on the intraday charts. I personally prefer the 1 hour time frame. Okay, that's my time frame of choice when it comes to intraday trading. Like I say, this is mostly an intraday strategy. Here we're going to be aiming for quick trades. Perhaps on average the time gap between the entry and the exit will be between 2 and 3 hours. All right, so this is going to be quick intraday trades, and we are going to be shooting for around 40 to 80 pips per individual trade. Okay, so quick positions, searching for 40, 50, 60 pips per position, keeping the trade open, running in the market for 2 or 3 hours. That's about it. Now, like I said before, the London Open breakout strategy is obviously based around the early London hours. Now, why is that? Well, as usual, I like to explain a little bit of theory, and then we will move on to some actual Forex charts. So, as you can see, in the world, there are quite a few main trading hubs. Okay, we have, for example, Sydney, we have Tokyo, we have Hong Kong right there, we have Frankfurt, we also have London, and I would say obviously New York as well. All right, so we have like 5, 6, 7 main trading hubs around the world. But out of those 5, 6, or 7, however many they are, the top 3 by far, the most important 3 are Tokyo, London, and New York. Okay, those are the big 3. Now, when it comes to Forex trading, and please mind that I say Forex and not stock trading, you know, it's a whole different thing, believe me. So when it comes to Forex trading, Tokyo pulls out around 12% of the world's global volume. All right, that's 12% there. London pulls out around 30% of the world's global trading volume, and in New York, believe it or not, is around 18%. Okay, that means that when it comes to Forex trading, the main player in the world is the city of London. It's not Wall Street, guys. It's actually London. Okay, so they due to the world's natural rotation, the first market to open up for the day is Tokyo. Well, actually, in fact, it's Sydney, but out of the main 3 is Tokyo. All right, so Tokyo opens up in there, then it runs for about 8 hours. All right, then London opens up, runs another 8 hours, and then New York opens up and runs for obviously another 8 hours, and there we go all around the world, and then Tokyo opens up once again, and so on and so forth. However, as you can see, there is about 1 hour overlap between Tokyo and London. Okay, as Tokyo is closing out for the day, London is waking up. All right, those 2 markets overlap for very briefly for about 1 hour. Now, as I mentioned before, Tokyo pulls out only 12% of the global volume, whereas London is a whole 30%. There is a huge volume gap between these 2 markets. So basically, this is the Tokyo activity, and once it actually overlaps with London, there is a volume explosion. All right, there is a volume acceleration as London wakes up in the market. This acceleration is where we are going to be, what we are going to look to profit from. All right, that huge influx of trading orders, of trading volume into the market around the first 1 hour or 2 of the London session, as Tokyo is closing down and London is kicking up, right? So as the London market kicks off, there is this huge market acceleration, and right there in the early London hours is where we are going to make our money. Okay, let's now take a look at this screenshot, which I've just taken, okay, barely a few minutes ago. That's current market price right there. And you will probably notice these colored boxes here, this one in purple, this one in red, okay, this one in red, etc., etc. Each of those boxes represent 24 hours worth of price action, okay? Basically, this is today's price action, this is yesterday, and the day before yesterday, and the day before, and so on and so forth, all right? Moreover, you will find this dotted line. You see this dotted line here? That represents the London market opening time. That's right there where the London market opens up for the day. Okay. By the way, this indicator that represents the day's price action and the London Open, you will be able to download as well from the members area. Okay. Anyway, so Please mind price action immediately after the London market opens up. So the London market opens up in there, and we immediately see that price acceleration I was mentioning before. Again, that's because the London-based volume kicks in the market, and since it's much larger than the one preceding the London market, meaning Tokyo, so since the volume is much larger, price is bound to accelerate. Okay, so price is already accelerating right after the London market has opened. Take a look at what happened yesterday. That was the London market opening time, and within 1 and 2 hours price moved from there. That's 50 pips, that's another 50 pips, so that's 100 pips within 2 hours. Not bad, is it? Not bad. The day before, that's the London market opening up there. The price was trading at that price level, and within 1, 2, and 3 hours price accelerated down here around, let's say, 60 pips within 3 hours. This day in particular was rather boring. There was no action whatsoever in the market. Please look how flat price action had been through the entire Tokyo session. The London market opens up, price barely moves 20 pips to the downside. So this is a trade, this is a day we wouldn't have traded the London Open breakout strategy. Okay, we require momentum to kick in at the London Open in order to make our profit. So we wouldn't have traded this specific day. We would have obviously traded this one. We would have traded this one. Seems like we would be trading as well today. And the day before, well, pretty much the same phenomenon. The London market opens up in there within one single bar, okay, 1 single hour, price moves from there all the way up there. So that's over 50 pips within 1 hour. Pretty much the same thing the day before. The London market opens up right there, and there it goes, that massive price acceleration as well. So as you can see, this is a recurring price pattern. I'm sure, in fact, if you scroll back in your charts, you will see how within the first 2-3 hours of the London session, we usually see this type of violent price accelerations. All right, and that's precisely the type of move that the London Open breakout strategy looks to profit from. All right, we wait for the London market to open, then we see whether the acceleration is kicking in the market. If so, according to a number of parameters, obviously, that I will explain through all the training videos, but according to some parameters, we will take our entry and we will be riding these momentum moves, okay, all those beautiful momentum moves, scoring, like I said before, between 40 and 80 pips between 1 and 3 hours on average, okay, between 1 and 3 hourly candles. Again, these are recurrent patterns that happens almost on a daily basis, as you can see, on any sterling pound cross or euro cross. In module number 3, you're going to learn all about the market flow system. Here, you will gain access to 20 more videos and 10 live trades. All right. This particular system is not restricted to any currency pair. In fact, you can trade it on any currency pair of your choice, or any currency pair that presents a trading opportunity. You are not restricted in any way, but this is an intraday system, and therefore you are to trade it on intraday charts. Again, my favorite one is the 1 hour time frame. In a nutshell, this system seeks to take trades between 2 intra-week structural levels, or rather 2 consecutive intra-week structural levels. Now, don't worry, I'm going to explain absolutely everything about intra-week structural levels, all right? In a nutshell, the idea is to map your intra-week charts, okay, your short-term charts with the key levels, the key structural levels, and we're gonna trade swings between 2 consecutive levels. All right, so it would be like from there to there. Then we would see the type of price reaction we get there. If we get a bounce, we're gonna trade from here to here. If we get a breakout, we're gonna trade from here to here, and so on and so forth, right? We are gonna map our intraday charts, our intra-week charts, in fact, with the key levels that we are to keep in mind, and we're gonna trade swings between two consecutive levels. Obviously, that means that every week we are gonna find multiple trading opportunities, right? Because price basically swings back and forth between those key levels, and every time we get a reaction from any of those levels, there we have a new trading opportunity that we can trade. Now, all in all, this system basically takes small trades, okay, no more than 30 or 40 pips per trade, but the beauty of it is that it triggers those opportunities all around the clock, as opposed to the London Open breakout strategy that's restricted to the first 2 or 3 hours of the London session. You can trade this system all around the clock because price continues to flow up and down between those structural levels, right? So no matter whether you trade the London session, right, no matter whether you trade the New York session or even the Tokyo session, all right, you can always find trading opportunities using the market flow system, okay? Okay, let's take a look into this screenshot. This is for the American dollar against the Swiss franc, 1 hour time frame, all right? There are a number of things you are probably noticing in this chart. First of all, we are mapping the equivalent of, let's say, 5, 6, 7 days worth of price data, of price activity, and that's because this is an intra-week, an intraday trading system, and therefore we are only going to be interested in what's been going on as per the intra-week price action. That means that we are only going to analyze the last 1, 2, 3, 4, 5, 6 or 7 days worth of activity, and we're gonna take our trading decisions based on that picture. We are not going to be scrolling any farther back in time. We only care about what's been going on through the week. The second thing you are probably noticing is these, all these gray lines that I've plotted in my chart, okay? Those are obviously the key intra-week structural levels that I was mentioning before, and obviously I will explain absolutely everything about them, what they are, how you can find them in your charts, why do they exist, why price does actually react of those levels. Do you see how price does react of those levels? Well, I'm going to explain all about them. I don't want to sound too technical on this presentation, so I will just say for the time being that these levels exist because of the natural laws of offer and demand in the market, okay? It's because there are a number of key forex players. I'm talking about hedge fund managers, investment banks, big traders working also for central banks, etc., etc. Well, all those guys have a number of huge pending orders waiting at those specific levels, okay, waiting to be executed into the market, and as those orders are indeed triggered into the market, there is a huge influx of trading volume punched into the market, and therefore price is bound to accelerate, is bound to react of those levels. Do you see those sharp bounces once price reaches those specific levels? Well, that's precisely because of that, because those are levels where big players in the market are waiting to execute their orders at those levels, all right? The third thing you're probably noticing in this chart are all these dots here, these red dots there, and the blue dots as well, okay? This is, well, obviously my custom indicator. I call it the bounce indicator, just because I couldn't find any more flamboyant name to it. And this has been obviously customly coded for me by my personal programmer. And this indicator is actually pretty simple, pretty straightforward in its definition, perhaps not in its algorithm, but certainly in its definition. Basically what it does is it tracks recent price activity, okay, very recent price activity in the very short-term charts, and it simply prints sharp price reactions, okay, sharp price reactions of those key structural levels, okay? So as price travels to test this key level, and as price finds rejection of that level, the indicator would go about printing in real time, of course, that blue dot in there. All right. So as you see that prices are reacting off the intra-week level, and as the indicator prints the blue dot, you are to seek your trade. Okay, you are to ride this swing from between two immediate consecutive levels, right? So that means from here to the immediate next above, this one up there, all right? So, as price troubles this swing, where you would obviously try to make, like I said before, between 30 and 40 pips, more or less on average, well, price retests this level, finds rejection once again, the indicator right there prints in real time a red dot, and you are to seek to trade somewhere between 30 and 40 pips, somewhere in here in between these two immediate levels. Pretty much the same thing happens all over again. Price travels all the way down, the indicator finds or basically detects this price rejection, prints the blue dot, and then you are to trade from there all the way to there. Again, 30, 40 pips. Obviously, I always recommend to exit your trade right before reaching this specific level. Let's say somewhere in there. So this would be where you would find your profits. Then we analyze price action. Does the indicator find a reaction there? No, it doesn't. That's why it doesn't print any red dot, because instead what we get is a momentum breakout. So as price breaks through, we are simply to wait for the next immediate level above, and that's obviously this level there. So we wait for price to retest that level. The indicator does recognize the rejection rather, and we are to trade another 30-40 pips to the downside. As you can see, this is a recurring pattern that happens multiple times through the week on every single currency pair, right? And therefore the market flow system always allows you to find multiple trading opportunities through the week. Module number 4 is called the part-time trader, and here you will find 20 new videos and 6 live trades. Okay, now I do realize that some of you may have a limited screen time, okay, to dedicate to your forex charts, perhaps because you have a full-time job, or perhaps because you have family commitments, or simply you don't want to sit at your trading desk many hours a day. Okay, I totally understand that, and that's precisely why I've decided to dedicate an entire module for all of you who may simply want to find some strategies that require no more than 20 minutes a day. Okay, basically I'm going to give you a bunch of strategies, okay, a bunch of techniques that you can apply perhaps right after dinner time, or in your lunch break, or perhaps early in the morning before going to work. Okay, so if you can dedicate 20-30 minutes maximum a day to your charts, that's all you need. Now, all these strategies can be applied on any currency pair, so you are not really limited there. However, and since you are indeed limited time-wise, we have to be more selective. Okay, so we are going to shoot for fewer but bigger trades. Now, as opposed to what we've seen in the market flow system, where we were taking multiple trades per week, but only shooting for maybe 30-40 pips per individual trade, well, here in the part-time trader module, we are actually going to reverse that situation, and we are going to look to trade perhaps just one single position per week, okay, just one trade per week, but we are going to make it bigger. Our average profit taking level is going to be 100, 150, even 200 pips away from our entry level, and therefore you could say that these strategies are more based on quality than quantity. Now, the reason as of why these strategies are so time friendly is because you can simply pre-configure your trade levels and walk away. Okay, when I say trade levels, I mean your entry point, your stop loss point, your profit taking level, your trailing stop level, etc., etc. I'm gonna show you how you can analyze all the different currency pairs in just 20 minutes a day, and then if you find the trading opportunity as per, well, the strategies that I will teach you, you would simply go about and pre-configure in your Forex platform your entry point, your profit taking level, your stop loss level, etc., and you just walk away for the rest of the day. All right, that way you can simply take off, do your thing for the rest of the day, and then simply come back in the evening, see how your trade did, and then spend another 20 minutes analyzing the market for the next day over. If you find any trading opportunity, again, pre-configure the next trade into your Forex platform, and that's it. You're done for the rest of the day. Oh, and by the way, and this is just a personal note, my students report that part-time trading, at least as per the strategies that I teach on this specific module, it's a far more relaxing experience than full-time intraday trading. All right. Obviously, you trade less often. You don't have to monitor the forex markets 24/7. You take your time to analyze the charts in peace. All right, and quite frankly, at the end of the day, it's just as profitable. I mean, do your math. It's basically the same thing, trading 3, 4, 5 times per week, aiming for, let's say, 40, 50 pips per trade, than if you simply took one trade aiming for 200, 250 pips for that specific trade. So at the end of the day, it's not really any less profitable than intraday trading. Okay, it's just simply trading at a much slower pace in a far more relaxed state of mind. Okay, now in module number 5, which is called the News Trader, you will find 13 new videos and 5 live trades. Okay, now as you probably know, the forex markets are hit on a daily basis, really almost on a daily basis, with important news announcements coming from every economy around the world. For example, the inflation data coming from the United States, the interest rates announcement coming from the Bank of England, the production index coming from the Eurozone, etc. And obviously, those news announcements do have an impact on your forex charts. Okay, so what we are going to study on this module is I'm going to try to make sure you understand news, okay, how they operate, how they work, and how, more importantly, how they affect the charts. Okay, not just how to read them, but also how they actually can affect your forex charts. All right, the point of this all obviously is to blend news announcement into your trading routine. Here I'm gonna try to help you blending fundamental trading and technical trading. Those are the two aspects of forex trading, okay, the two sides of the same coin. Fundamental trading relates to the news, okay, to the world macroeconomics, and technical analysis trading is based on the charts, right, on trends, on levels of support and resistance, breakouts, Fibonacci retracements, that kind of stuff. Okay, well, in this module, I'm gonna teach you how to actually blend both aspects of trading in order to exploit the news extra momentum to your benefit. Because make no mistake, the news generate a huge momentum in your forex charts. Price can easily move 50 pips within a few minutes, and I literally minute, okay, 50 pips within the, at the blink of an eye, and you can either see that as a threat or as an opportunity. Well, in this module, I'm going to show you how you can actually exploit that extra momentum as an opportunity, all right, as a benefit to your trading and not as a threat anymore. Anyway, let me now show you this actual chart. This is a real trade that I took myself, and you will find the full video recorded in real time within the mentoring program. At any rate, I want to show you these screenshots just so you see the type of price spike you see around news announcements. Okay, this is the sterling pound against the Swiss franc in the 1 hour time frame. The reason as of why we saw this huge price spike, which ran up for about 85 pips within half an hour maximum. Okay, the reason why price accelerated is because at that precise moment, somewhere around there, the inflation data, the inflation report coming from England hit the market. Okay, and since this is a sterling pound related cross, all the sterling pound currency pairs were meant to be affected. Okay, this time around I just happened to be trading the pound against the Swiss franc. So the news come out there that creates extra volatility, extra acceleration, momentum in the market, and price, like I say, moved 85 pips to the upside. Now, most people would be afraid of trading around news announcements precisely because of these chaotic price spikes. But I'm going to show you a number of techniques as of how you can use that extra momentum in your advantage. All right. For example, let me very quickly give you a hint on one of the techniques that I use myself. I draw intra-week levels of support and resistance, such as, for example, this one. As you can see, price topped out at that level a number of times. Okay, that was a significant level of resistance as per the last few days. You know, one of those key structural levels from an intra-week point of view that I was mentioning earlier on in this video. Well, that's one of them. And as the news announcement hit the market, price took off, retested this specific level of resistance, but it failed to pull through. Okay, the news announcements are released right there. Price shoots off, hits that level of structural resistance, and from there it fails to pull through and finds reaction and retraces hard from that level to the downside. Okay, now by blending the news spike with my technical analysis, in this case the level of resistance, I've been able to gain a very valuable piece of intelligence, and that's that level of resistance is very strong. There are a number of sellers waiting to jump on board, waiting to sell the sterling pound against the Swiss franc around this area, because even the news with its phenomenal momentum was not really able to breach through. See how price hit that level and then it retraced back just as fast? That means that there are plenty of sell orders waiting to be triggered, and as price reaches up this level and all those orders get triggered, price decelerates and comes back down just as fast as it actually shot up. All right, so as I saw prices coming all the way up there, I was actually following this in the 15 minutes time frame. So as I saw price accelerating to the upside, hitting on that level and then beginning to retrace back down, I knew for a fact that the technical level was actually to overcome the news momentum, and I sold short right there. I don't know if you guys see my sell level from this screenshot, but anyway, that dotted line was my sell order. My stop loss was immediately above the tip of the spike, of the news spike, and that was my that was my exit order, my profit taking level right there, which got triggered basically within a few minutes. All this news spike, happened very fast in the market, and therefore, whenever you trigger a trade, your profits are hit very fast as well. All right. So, do you see how by blending fundamental and technical analysis, I can gain an extra piece of information in this equation that otherwise I wouldn't have been able to gain? All right, now I know that this is an ideal area to sell the sterling pound against the Swiss franc, because like I said before, not even the news with its extra momentum spike were able to push through, and therefore the best bet once price goes up to that level is to sell the news spike. This technique, by the way, it's called to fade the spike, and it's very powerful. Now, this is a little advanced as a forex technique, but don't you worry, you will learn absolutely everything about this technique and many others related to news trading within the mentoring program. Okay. So, once you've gone through this module, the News Trader module, you will see that news announcements and news spikes are not really a threat to your technical analysis. In fact, it's an advantage, something that you can benefit from. Anyway, let's move on. There is another whole module dedicated to money management. This is so important that you will find 13 whole videos dedicated to it. You see, remember when at the beginning of this presentation I was mentioning that successful forex trading is not really about your particular trading system or the particular indicator you may be trading, but rather it's an analytical game where in the long run, this is all about statistics and ratios. Well, this is in this precise module where we bring everything together and I explain why money management can totally make or break any trading system. Okay, you see, even if any trading system pulls out a phenomenal 75% win-loss ratio, if you don't apply sensible money management policies into that system and into your trades, sooner or later your account will suffer from it. Okay, believe me, that's a guarantee. Now, you will find different money management formulas within this module because perhaps you may want to apply a different formula, a different approach depending on whether you are taking an intraday trade or perhaps a long-term trade, etc., etc. Okay, we are going to be talking about risk ratios, how you may want to adjust and dynamically modify that ratios depending on what type of trades you are taking. Moreover, I'm going to explain the correlation trap, which is a common mistake among new traders. You see, they don't realize, they are not aware that different currency pairs are actually correlated with each other, and therefore if you score a loss on one specific currency pair, chances are that you will also score losses on all your other trades that you may be running simultaneously, right? So I explain which currency pairs are correlated with each other, in which way, and how you can avoid being overexposing your account by taking multiple trades on correlated currency pairs at the same time. Okay. Moreover, we are going to review sequential exit policies, when it's best to perhaps not exit your trade in just one go, but perhaps you may want to actually scale out of the trade as it moves in your direction, perhaps exiting one lot right there, then another 2 lots in there and another lot, and then perhaps leaving 1 or 2 final lots running for, for extra profits. I'm going to explain all the different sequential exit policies and at the same time the different trailing stop policies, just so you know at which precise time in your trade perhaps it may be sensible to actually get your stop loss and trail it to break even in order to risk on this second half of the trade a risk-free trade, just in case it turns around and it actually actually hits your stop loss, right? So I'm going to be talking about the different the different procedures as far as minimizing your risk in your trade. Also, you will find different formulas to, as price moves in your direction, you tighten up your stop loss progressively as well. Okay, and finally, you will gain access to my trade journal, which is actually a software that my programmer coded for me. Now, the point of a trade journal is to document, to record all your trades and all the information related to those trades. So over time, as you record more and more trades, the software will draw some statistical intelligence, some statistical data as per your performance, and moreover, what's most important, as per your potential, let's say, weak points in your trading. Okay, therefore, once you have a broad enough spectrum of trades recorded, the software will be able to tell you exactly where you are perhaps incurring in recurrent mistakes. So once you are aware of them, you can polish them out and as a result improve your performance. Let me actually show you a screenshot of the software, the trading journal software itself. This is the specific page where you insert every new trade into the database, okay, into your track record database. So here you would simply fill out all these fields, such as, for example, what trading system this trade belongs to, the trading account, the date, the currency pair, whether you went long or short, the time frame, okay, 1 minute time frame, 5 minutes time frame, 15 minutes time frame, etc., etc. What trading session you took the trade at, the early London, late London, New York, etc., etc. The time span, whether the trade took less than 15 minutes from entry to exit, that means that it's a scalp trade. Here you will also see it took about 1 hour, about 3 hours, 8 hours, 1 day, less than a week, more than a week, etc., etc. The score in pips, the account balance before the trade and the account balance after the trade, the pre-entry risk reward ratio, whether the trade was a win, a loss, or a scratch trade, the size of your stop loss, whether your original stop loss was hit, whether you trailed your stop loss, whether your trailing stop loss got triggered or not, whether your final target got hit, how many partial targets, how many sequential targets did you implement into this trade, how many of those partial targets got triggered, and so on and so forth. Okay, obviously you will need to scroll down to fill out yet more fields. So as you can see, it's a very detailed software where you insert and document absolutely every single variable of your trades. And once you've inserted enough entries, enough trades into the database, the software will calculate any type of ratios and statistics you can possibly think of. Okay, you will be able to see whether you are scoring better results with this or that system, whether you are scoring better results by trailing your stop loss to break even midway through the trade or not, whether you are scoring better results by trading in the early London session or in the New York session, whether you are scoring better results by implementing a sequential profit-taking level policy, or whether you are simply getting better results by exiting your whole trade at once, whether you are best sticking to the shorter time frames or to the longer time frames. Absolutely everything, guys. This trade journal has been one of my #1 secret tools to improve my trading over the years. Okay, because over time, like I say, you will know for a fact from a statistical point of view what works for you and what doesn't. What are your strong points as a trader and what are your weaker points as a trader. And therefore all you have to do is to continue doing what you do best and simply filter out the type of the type of trades that are not quite working out for you. All right. For example, this chart tracks your trail stop loss performance, basically whether you score better results by either trailing your stop loss to break even midway through the trade or not. Well, obviously we can see that you score better results by trailing your stop loss to break even. So that's something that you want to keep on doing. Okay. This other chart tracks your performance as per the trade's time span, okay, the trade's time frame, whether you score better results by, for example, trading intraday trades or very short-term trades, meaning scalp trades, or perhaps intra-week trades, medium-term trades, or perhaps longer time frame trades, etc., etc. So by analyzing this data, you know that, at least on this specific case scenario, your better results come from intraday trading, and that's obviously something that you want to keep on doing because it's working for you. So by analyzing all this data over time, you will sharpen up your skills and your performance as a trader. Very, very important stuff. Okay, let me now show you the exclusive bonuses you're gonna get also when you sign up for the mentoring program. The first bonus module is called the Price Action Reading Doctorate, where you will find 8 new videos exclusively dedicated to trading naked. And no, that's not probably where you're thinking. It's all about reading price action and interpreting price activity without the help, without needing any external indicator whatsoever. All right. We are going to cover a number of topics, such as, for example, how to nail your key levels of support and resistance. You see, key levels of support and resistance are the bread and butter of any technical trader. No indicator, no system whatsoever, no matter how complex they are, can possibly outdo key levels of support and resistance. This is the #1 priority for any chart-based trader. Okay. Moreover, once we have our key levels of support and resistance in place, we are going to analyze price action or price reactions around key levels of support and resistance, okay? Because that gives you a great intelligence on price behavior in any currency pair, and as a result, you'll be able to determine very accurately whether the next immediate move is going to be to the upside or to the downside, so you can trade accordingly, okay? So firstly, we are going to analyze, or we are going to map our charts with those key levels of support and resistance. Then we are going to analyze price reactions. Once price reaches up to one of those levels, we are going to monitor price reactions around those levels, and depending on how price behaves around that key level, we'll be able to determine whether in the immediate next future, or in the very close future, whether we want to trade a swing to the upside or a rejection to the downside, okay? And the only way to get let's say a hint on the next immediate move is to analyze that reaction of key levels of support and resistance. Moreover, I will explain all about areas and not levels of support and resistance, okay? Please mind that I say areas and not levels. You see, these areas are areas where, a number of pending orders are waiting to be executed into the market, okay, by the big forex players, hedge fund managers, investment banks, etc., etc. Those are areas where those big traders are waiting to enter the market, and as a result, once price reaches those areas, price tends to accelerate due to the massive influx of trading volume into the market, okay? You've got to be prepared to, first of all, obviously spot those areas, and moreover, how to trade accordingly, okay? How to trade once price actually reaches these areas of greater trading volume. Furthermore, once we've mastered the price action, once we've nailed down those key levels of support and resistance and areas of support and resistance, and more importantly, price reactions around those levels, I'm going to teach you how to actually blend price action reading with your trading system, okay? Trading system meaning the London Open breakout strategy, the market flow system, all those strategies that you will find within the part-time trading module or within the news trading module, etc., etc. Well, I'm going to show you how to actually blend that extra intelligence you gain from price action reading into those trading systems in order to achieve the ultimate trading methodology. Okay, you are going to be backing up a profitable trading system with the ongoing price action. And trust me if I say that that's the ultimate trading combo. And finally, you will learn something that's perhaps a little more advanced, okay? This may be aimed only or exclusively to advanced forex traders, and that's multi-time frame trading, okay? Basically, when we analyze one specific currency pair, we are gonna grab different pieces of information coming from different time frames: the intraday charts, the medium-term charts, the long-term charts, and we are gonna blend all those different signals coming from different time frames. We are gonna blend it together in order to make one single trading decision. But like I say, this last point is a little more advanced, so I recommend you to go through these topics first, okay, before drilling down into the advanced stuff. As a bonus to the mentoring program, you will also get my custom indicators. All in all, there are 10 proprietary indicators that, like I said before, they've been customly coded for me by my personal programmer, okay? That means that you cannot find them anywhere else. Those are the indicators that originally I asked my programmer to code for me because I needed them in my own trading activity, and now I would simply like to pass them on to you in case you find them useful as well, okay? And I'm sure you will. Now, I would like to go back into a previous slide in this presentation. Remember the 4 pillars to a long-term forex success? Well, the first one, if you remember, was to trade a sound, solid, no-nonsense, real-world trading approach. That's exactly what you are going to find on the DVDs, okay, on the tutorial videos. Now, point number 2 was to trade with the appropriate tools. Remember, I really want you guys to avoid trading with useless indicators that are going to get you no results and moreover are going to get you totally confused, okay? That's why I really want to share with you actual indicators that actually work, okay? Because like I said before, they are based on a real world trading approach. So Let's recap on those 10 proprietary indicators that you will get. In fact, some of them you've already seen through this presentation. Remember the 3 SMA indicator? That plots the buy area in a trend and also the exhaustion bands where to exit the trades. Well, you're gonna get that one. Fantastic stuff to trade within trending market conditions. Also, I'm going to get you an indicator that's specifically designed for the London Open breakout strategy. Basically, it's a indicator that scans price action around the London Open and then it signals or it marks whether there is a potential London Open breakout setup on that specific currency pair. Okay. Moreover, in case you want to actually track all the different currency pairs for the London Open breakout strategy, at least those related to the euro and to the sterling pound. Okay, remember that the London Open breakout strategy is only to be traded on euro crosses and on sterling pound crosses. Well, I'm going to also give you access to one of my favorite ones. That's the London Open breakout scanner that basically signal those currency pairs that are presenting a London Open breakout setup for the day all across the board. Okay, this indicator basically tracks all the different London Open breakout currency pairs at once, so you don't actually have to drill down, you don't actually have to monitor all those different charts individually. You just open up the London Open breakout scanner and you can see within the blink of an eye which currency pairs are to be traded and which ones are not. Okay. Moreover, and you've already seen this one as well, the bounce indicator for the market flow system, okay, tracking sharp bounces in the short term price activity, and therefore you can trade price reactions if they happen straight off one of those key intra-week structural levels. Okay, if the indicator signals a sharp bounce of one of those levels, then you have a high probability trade looking to profit from the swing from that specific intra-week level all the way to the next one. Again, that usually gives you room enough for 30 or 40 pips, from an intraday trading point of view. Next, and since I believe money management is a very important aspect of trading, I've included a money management indicator. Okay, this one basically will tell you all about your trade, the risk profile of the trade, correct target and stop loss levels, the recommended trading size for that specific trade, okay, the profit taking levels as well, the risk reward ratio on that specific trade as well, etc., etc. Basically all the money management factors or elements that you need to take into consideration in order to make sure that your trades comply with a sound and solid money management policies. All right. Moreover, in the News Trader module, you will find the Forex Economical Calendar indicator. This indicator basically tracks or plots all the different news items, news announcements coming for the day, or coming from every single economy in the world, or related to every single major currency: the sterling pound, the Australian dollar, the Japanese yen, the euro, the Swiss franc, etc., etc. That way, the indicator alerts you in advance of all the news items that you should be aware of. Okay, so for example here, you know that at 10:30 a.m. coming from England, okay, related to the sterling pound, the trade balance is hitting the market. This is an important news announcement because it's marked in red, okay, so that's certainly something that you need to keep in mind. And therefore, if you are trading or looking to trade any sterling pound cross on that day around 10:30 a.m., well, you should be aware that because of this news announcement, we may see a chaotic spike in price action, and obviously that's something that you want to be alerted in advance before it actually happens, right? And this actually serves two purposes, really. First of all, so you are not caught up by surprise on those chaotic, wild price spikes that we usually see around news announcements. And purpose number two, so you are actually ready to profit from that spike. Okay, you are ready to take your move, to take your trade right as the spike is taking place, and you profit from those massive market accelerations. Okay. Anyway, you will gain access to all these indicators and many others as well. Like I said, for a total of 10, you will gain access to all of them within the mentoring program. Now, needless to say, I will also attach a tutorial video for each of those indicators, just so you know how to install them, how to get them running in your charting platform, and more importantly, how to use them and how to trade them. Now, I would like to go back into those famous 4 pillars for a long-term Forex success. We've already covered the first 2, and now I would like to address the third point, guidance. Guidance from an experienced trader, of course. Now, while I don't believe that this is 100% necessary, I believe it's very useful indeed in order to speed up the learning curve. Obviously, you can totally learn this game on your own from studying the tutorial modules, now that you also have access to the appropriate indicators, but a little bit of guidance won't hurt. Okay, at any rate, it will certainly help you speeding up that learning curve. And that's why I have indeed included guidance into the mentoring program. Okay, I'm gonna give you access to my personal email address. All right, this is not my business email address. This is in fact my personal email address, and you're totally welcome to contact me. Okay, if you would like to share any chart, any setup you are about to take, okay, any trade perhaps you may have taken that didn't quite work out and you want to know why, or you simply want to know my feedback, hey, I'm available. I'm available here for you guys. All right, simply contact me, send me an email with your chart, with your specific question, and I will always get back to you within 24 hours. All right. Again, this is my personal email. I'm going to ask you for a favor here. Please don't disclose this email. Don't share it around. All right. This is just for my students. Okay. For anyone who actually takes the step to join the mentoring program. So while it's entirely available for you to use it, as long as many times as you wish, I'm going to ask you to please not share it around to any other person outside the mentoring program. Okay, and on top of that, just to make sure that I go out of my way to help you as much as possible in your trading, we are all gonna come together in a webinar room on a weekly basis. Okay, we are gonna conduct some weekly webinars because I believe that those sessions, those webinar sessions, are indeed the best way to clear up doubts. Okay, to address questions. We are gonna look into live charts. We are gonna look into any specific requested chart or trading setup that you may wish. Okay, we are all gonna share all that together because quite frankly, my number one priority here is that you absorb those training contents, okay, that training material within the mentoring program, and you put that to action as soon as possible. Okay, for me it's very important that not only you learn profitable trading strategies and techniques within the members area, but also that you actually apply that into your own charts. Otherwise it will make you no good, right? And otherwise it will all be a waste of time, right? So I believe that via daily email contact and via weekly webinars, we'll be able to get you up to speed so you turn all that educational material into actual Forex profits. Trust me here, this is my personal promise. I will go out of my way to provide the guidance necessary, whatever it takes, to turn you into a profitable Forex trader as soon as possible. You have my word. Anyway, we have finally covered all 3 pillars that I can help you with as far as becoming a long-term successful Forex trader. However, the last pillar, which is probably the most important of all, well, that's something that you will have to do on your own, okay? Only you can take your trading seriously. So, if you would like to indeed take the extra step, if you would like to put in the effort to become a successful Forex trader, as far as taking action goes, that's all entirely up to you. All I can do is to invite you to join my mentoring program. I believe it's everything you need to know as far as turning the corner into a Forex profitability. You see, only you can make that final decision. However, and since I do realize that every time a new opportunity is presented to you, it may seem like a daunting task, okay? You may go through a little bit of hesitation. I would like to make it as easy and straightforward for you as possible. That's why I would like to offer you a full 30-day trial. All right, no commitments attached, no responsibility on your end, none of that at all. Okay, you have a full month to go through all the tutorial modules, watch all the videos, download the indicators as well. All right, put them into action, and if you see that your trading results are getting better, and trust me, I believe they will, well then, hey, with all my compliments, keep the mentoring program. If in the other hand you see that they are not helping you, or it's just not what you were looking for, or my trading methodology is perhaps it doesn't fit your trading style, okay, whatever the reason may be, you have 30 full days to simply get a refund. Simply send me an email, just say, hey Hector, this is not what I was looking for, thanks for the opportunity, but I've decided not to keep it. Please issue a refund, and obviously right away I will issue the refund within 24 hours. Okay, usually it doesn't take any more than 24 or 48 hours to for the refund to be processed. Okay, so again, join in, absolutely worries free, you have nothing to lose, okay, all the risk is on me. Consume all the contents and download and use the indicators, please, and then, hey, in 30 days time, take the decision whether you want to keep it or whether you would rather have a refund. Either way, I will totally respect it. So finally, I reckon it all boils down to, are you serious about Forex, really? Would you like to learn actual real-world trading strategies? Are you ready to finally become profitable and consistent in your trading? Because if so, if you've answered yes to these questions, then quite frankly, my recommendation is to simply join the mentoring program. You have my word, you will not regret it. So, if you've made up your mind and you want indeed to be part of the club, then you will find all the information somewhere down there. And for all of you who want to take that extra step, I'll be delighted to work with you over the following weeks, working on your trading skills and finally getting you to the top of your Forex game. Alright? Well, until then, thanks for being part of this fantastic opportunity, and I'll be waiting for you at the members area. Cheers!